Hi, this is Lance Edwards, and welcome to this session of Greenlight REI. This is where we give you the recipe for the successful real estate lifestyle. And for this session, I'm going to be talking about a topic that I get a lot of questions about, and that is how do you profit with small apartments, particularly how do you run the math. And the great thing about small apartment investing is it's all based upon math and knowing what is the good math with regards to your investment. So the topics, the agenda for today, I've got a number of things. Number one, what is an ideal investment? I want to make the case for small apartments. Number two, how do I know if it's a good deal? And this is probably the largest question with regards to people getting started because you don't want to be taken advantage of. There's a lot of junk out there. You can go on the websites and find there's a lot of junk. And so how do you know it's a good deal? I'm going to show you and teach you precisely that today. How is the market value determined? This is related to how to know it's a good deal. I'm going to show you how to know from the back of an envelope how the market value is determined. And when you own these buildings, I want to point out all the tax benefits associated with them because a lot of people are not aware of these fabulous tax benefits. How you can actually pay zero income on or zero tax on your job income if you own a sufficient number of rental properties. And then the final thing I want to talk about today are what are my exit strategy options. So you can go into a property. What are all the ways that you exit and make money? And I think you're going to be amazed at these as well. Now, what I'm going to tell you, I'm going to share with you, there's an article or a new special report that I've created, How to Profit with Small Apartments. I want to invite you to get that as well because, first of all, let me give you the instructions. I want you to write this phone number down, 832-446-1772. 832-446-1772. And if you will text your name and email to that number, just text your name and email to 832-446-1772. We will email you this special report within 10 minutes. This special report is what I'm going to be highlighting in today's podcast session, but the math is shown in more detail in the special report. I could try to step you through the math here on a podcast. I don't think that's the best way to do it. You want to be able to see the numbers because the numbers are going to amaze you in terms of the ROI. So I want you to go get this report. It's called How to Profit with Small Apartments. Again, 832-446-1772. Text your name and email to 832-446-1772. And of course, it'll be in the show notes as well how to do this. And all right. So I already gave you the agenda. Let's hit the top topic. What is an ideal investment? What defines the ideal investment? And this is something that I learned when I was just first getting started many years ago. My very first mentor taught me this, that there's a 5-point checklist to defining the ideal investment. And if you take the 5 letters in the word ideal, that becomes an acronym for the 5 attributes or the 5-point checklist of the perfect investment or the ideal investment. The I in ideal means income. The ideal investment has strong cash flow. And when it comes to apartment buildings, what we are looking for is a minimum of $100 per door per month cash flow. This is the cash flow after paying all the expenses, after paying the management company to run it for you, and after paying the cost of your money, whether it's conventional financing or private financing. Net, you should expect a minimum of $100 per door per month cash flow. All right, so income. So apartments certainly have that. The D, or the second attribute of the ideal investment, is it has depreciation. Specifically, depreciation tax benefits, which I'll be talking about today. And it's the ability that the IRS allows us to depreciate the value of a piece of real estate and use that depreciation to offset the income tax we're paying on our job income. Now, this depreciation is a paper loss. It's not a physical loss. It's simply a paper loss that has huge tax benefits to us. So depreciation, apartments certainly have that. The E in ideal stands for equity, and this is the third attribute of the ideal investment. And in the case of apartments, we create equity for ourselves by one of two methods. Number one, we get free equity when we buy a property at a discount. Equity being the difference between what the market value is and our purchase price. The difference between the market value and our purchase price is free equity. That just comes from negotiating. The second way that we generate equity over time in these apartment buildings is by paying down the mortgage. Because every month that a mortgage payment is made, which is being paid by your renters, not by you, the building is paying the mortgage. You're not. This is not your home. The renters or the tenants and your buildings are the ones paying down your mortgage for you, where every month they are building your equity by paying down the balance on this mortgage. So there's two ways you get equity. One is by negotiating up front to buy it at a price below market value. And secondly, over time, as the renters pay down the mortgage for you. All right, the fourth attribute of the ideal investment is the A in ideal, means the investment affords you appreciation. Appreciation. The value goes up. This is yet another way to grow your equity. And in apartments, there's actually two ways to get appreciation. One is through something called forced appreciation, and the other is market appreciation. Now, market appreciation is something that we don't have control of. If market forces drive the values up, that's great news for us. But the real value that I want to talk about today in today's session is what's called forced appreciation. It's the ability to force the value of your building to go up by raising the rent and raising the occupancy, and to do it in a predictable manner. So that's appreciation. Your apartments have that. And the fifth and final attribute of the ideal investment is leverage, the L. And leverage means our ability to buy or purchase an investment using other people's money, OPM. And certainly that's possible in apartments. That's everything that I teach. You can buy apartments with 100% leverage using private money, where that private money includes the seller and combination of a private investor, or sellers can give you 100% financing. But getting that leverage is where your real power comes from. And I'll show you the metrics that are used to just demonstrate and measure the amount of financial leverage. So you got the five attributes: income, depreciation, equity, appreciation, and leverage. And when you add them up, apartments are one of the few vehicles that have all five attributes of the ideal investment. And this is one of the many reasons that I chose to get started in apartments, because it fits the attribute of the ideal investment. All right, so the next thing we'll talk about is, how do I know if it's a good deal? How do I know if it's a good deal? And in this section, I'm going to introduce the metrics, the financial measures we use to evaluate apartment projects, and the same ones that you're going to use. And then I'm going to show you the buying criterion, what those numbers should be when you're evaluating, because your purchase or your buying decision, your purchase decision is going to be based upon just a few metrics that I'm going to give you the guidelines on them in this section. All right, so let's talk about a good deal. There are three performance indicators when looking at an apartment building. Number one is something called the cap rate. Otherwise, it's a shorthand for the capitalization rate. It measures the financial return on investment on a percent per year basis, annualized. The second performance indicator is cash on cash return. It's also an ROI, an annual ROI. It's going to measure the financial leverage you receive from buying property using other people's money. And the third performance indicator I'm going to teach and explain is the 5-year annual ROI. This takes into account your return not only from income, but also your return from equity. So if you recall the ideal investment, the ideal investment has both income and equity. The 5-year annual ROI is the measure to measure the income and the equity contributions. The first two, cap rate and cash on cash return, solely measure your return from income. All right, cap rate. Again, this is shorthand for capitalization rate. This is the common denominator across all commercial income producing properties. This is how we do side-by-side comparisons on commercial properties, certainly apartments. And the formula for cap rate is this. The cap rate is the NOI divided by the price. NOI stands for net operating income, and net operating income is the revenue minus the expenses. Revenue minus expenses. So an apartment building revenue is the rent, is primarily the rent income that's coming in, but it also could include other income such as late fees, application fees, vending machine income, washateria machine income, parking fees, etc. The other income could be anywhere from 3 to 15% of revenue, but primarily it's rent. Now, expenses includes every expense necessary to operate the building, with one exception. Well, let me qualify that. Expenses includes everything. It's the taxes, the insurance, the maintenance, your management fees, all of those expenses. But expenses excludes the debt service. Expenses do not include the mortgage payments. That's going to come up just a moment later. But when you do cap rate, when you figure calculating expenses, do not include the mortgage payments. So the buying criteria, when you calculate a cap rate, well, let's go back for a minute. Let's go back. So as a simple example, if you have a property that has an NOI of $30,000 and you're going to buy it for $300,000, then your cap rate is 10%. That would be called a 10 cap deal. That says that if you were to pay all cash, if you were to pay $300,000 cash for that building, you would get a 10% return on investment from the income. That's cap rate. So the buying criteria, when you're looking at apartment buildings on the commercial side of 5 units above, you want to purchase at a cap rate at least equal to the market cap rate. You want to purchase at a cap rate at least equal to the market cap rate. All right, that's your cap rate. Cash on cash return. Now, this is the measure of leverage. This shows you how much ROI you're getting from the small amount of cash you're putting in these buildings because you're buying them using other people's money. And the formula for cash on cash return is this. Cash on cash return equals cash flow divided by cash in the deal. Cash on cash return equals the cash flow divided by cash in the deal. So that cash flow is defined as your NOI minus your debt service. This is in dollars per year. So we explained NOI in the previous slide. Debt service is your mortgage payment. So cash flow is what's left over after paying the mortgage payments. After paying the financing cost, cash flow is what's left over. So obviously, to have positive cash flow, your NOI has to be larger than your debt service. And cash flow is dollars per year. Now, the other variable I need to introduce is cash in the deal. How much total cash did we put into this property? Well, if you're buying it with financing, if you're putting a mortgage in place, that means your cash in the deal comes from 3 areas. The down payment, that's cash at closing, your closing cost, plus any rehab costs that need to go in to address any deferred maintenance. Anything that needs to be done at the offset to get this property back to where it needs to be. So cash in the deal is your down payment, your closing cost, and your rehab cost. Now, from that, go back to the definition of cash on cash return. That is simply the cash flow divided by the cash in the deal. So if I can give you a simple example, and I give a detailed one in the special report I want you to access. If we build upon the example I just gave where it had an NOI of $30,000, and if the mortgage payment is $18,000, that means the cash flow is $12,000 per year. Okay? That's net in your pocket, $12,000 per year. And let's say your cash in the deal was $80,000. $80,000. Well, the cash on cash return would be the $12,000 per year cash flow divided by $80,000 cash in the deal. So your cash on cash return would be 15%. 15%. Now remember in the example I talked about cap rate, the cap rate was 10. Now the cash on cash return is 15%. It's higher. Cash on cash return is always going to be higher than the cap rate because of the financial leverage. And this is why people buy real estate with leverage, is because instead of putting $300,000 cash in to buy the building, you're putting in $80,000 cash, and instead of getting a 10% return, you're getting a 15% return on that cash. It gives you greater ROI on your cash. And that's what cash on cash return measures for us. And when you're buying a property, this is the primary thing that you're looking at when you're interested in cash flow. Because it measures how much financial leverage you're getting off of this investment. So your buying criterion when it comes to an apartment building is this. Your cash on cash return should be at least 10% for a solid cash flowing property. Now, I want you to compare this to your CD. If you have any money in a CD earning maybe 1%. So you could put your $80,000 into a CD and earn maybe 1% per year. Or you could put your $80,000 into an apartment building and earn at least 10 times that cash on cash return, plus have all the other benefits we're going to be talking about here in a moment. All right, so your minimum cash on cash return should be 10%. All right, the third performance indicator is your 5-year annual ROI. And this is what measures the return not only from income, but also from equity. And it's this, and I've got a number of variables here, but the first thing we got to look at is what's the total return you're going to receive from an apartment building over 5 years. Well, you've got 3 components. You've got 5 years of cash flow that accumulates, you're going to receive over 5 years. You're going to have the free equity when you buy the property by buying the property at a property less than the market value. So you get that free equity at closing. And then the third component of the total return model is the 5-year mortgage paydown, which your tenants are going to be doing for you. So you get 5 years of cash flow, that's income, plus free equity at purchase, that's part of your equity, plus 5-year mortgage paydown. That's the other part of your equity. So the annual ROI over 5 years is your total return in dollars divided by cash in the deal divided by 5 years. Now, in the special report, you'll see the example here. But the one thing that I really want you to understand, and let me go through the example in the special report. Let me just give you these numbers. So a moment ago, I said there was $12,000 per year cash flow. So the 5-year cash flow is $12,000 per year times 5 years. That's $60,000 cumulative cash flow. Now, the market value of this property is $352,000. I'm going to show you how to determine that in a minute. We were buying the property for $300,000, so you've got $52,000 of free equity at closing. And the mortgage pay down, your mortgage goes from $256,000 paid down to $226,000. You have $29,000 of mortgage pay down over those 5 years. So when you add it up, your total return is $122,000, 5-year total return. Your cash in the deal was the $80,000 that we referenced a moment ago. So your 5-year ROI is 30% per year. $122,000 divided by $80,000 divided by 5 years is 30% per year. Now, what investment can you point to that gives you 30% per year as predictable as apartment buildings? That's secured by a physical piece of real estate. And that is why apartments are the ideal investment. Because as a buying criteria, your 5-year annual ROI should be at least 15% for a solid cash flowing property. I just gave you a simple example of 30. But your minimum criteria should be at least 15% for that 5-year annual ROI. And again, I would challenge you to find other passive investments that yield that type of return. All right, so let's recap it. There's the 3 performance indicators. There's your cap rate. That assumes you're buying the property for all cash. It's the common denominator. It's how we compare properties across each other by cap rate. The more important performance indicator when you're buying is the cash on cash return, because that measures the return on investment you're going to receive on the small amount of cash you're going to put into these buildings relative to the total purchase price, because you're going to use financial leverage. And the third performance indicator is what measures the income and the equity return, and that's the 5-year annual ROI, and that will be even a greater number than the cash on cash return. So 5-year ROI would be greater than your cash on cash return. Your cash on cash return will be higher than your cap rate, assuming you're using other people's money. All right, now this next topic, how is the market value determined? In the last section, we talked about how to calculate your equity, the difference between the market value and your purchase price. So precisely how do you know market value? Well, I'm going to give you 2 answers here. It depends on whether it's 2 to 4 units or 5+ units. 2 to 4 unit buildings are considered residential, and the market value is simply the comps. Comps being the comparable price. You've got to compare other similar buildings in the area that have sold in a similar reasonable time frame to come up with comps. It's quite subjective if you've ever pulled comps before. When you get to 5 units and above, you're in the realm of commercial, and there it's very objective. It's scientific. There's no subjectivity on the market value for a commercial apartment building, because the market value is simply the NOI divided by the market cap rate. Now, the market cap rate will vary by market. It's obtained by speaking to commercial real estate brokers, by asking them what the market cap rate is. But the market cap rate is the average cap rate that the market will accept for retail priced properties. Now, let me say that again. The market cap rate is the average cap rate that the market accepts for retail priced properties. The market sets it. They do not change dramatically normally. For example, in Houston, where I live, the market cap rate for a Class C building right now is 8.5%. For a Class B building, it'd be around 6%. So that means once I know the market cap rate, let's say it's 8.5%, if I calculate the NOI on a building, I automatically know the market value of that building. This is exactly the same approach a commercial appraiser takes when he appraises a commercial building. This is called an income-based appraisal. And it tells us that the market value of a building is solely a function of the net operating income. And the net operating income is the revenue minus the expenses. So the way that you can increase the value of an apartment building is to raise the NOI. which means you can raise the revenue. How do you raise the revenue? Well, you have one of two ways. You can raise the rents and or you can raise the occupancy. Get more people living in there, so more people are paying you. And that is the essence of apartments right there, is learning how to control that NOI, because it sets your cash flow and it sets your equity by it changes the market value. And this is the real power of apartments, is knowing scientifically how much money you can make by simple adjustments to the operation of these buildings, specifically that are carried out by your management company. All right, so we've covered how to know if it's a good deal, how is the market value determined. Now, let's talk about the tax benefits of apartments. And I've got several of them we're going to talk about here. The first tax benefit is that, first of all, on your cash flow off your apartments, you're going to pay the lowest tax rate afforded by the IRS, because this is passive income. So apartments afford you the ability to pay the lowest tax rate on the highest income. Apartments afford you the ability to pay the lowest tax rate on the highest income. You can have unlimited amount of income on apartment buildings, and the tax rate's always the same. It's the lowest set by the IRS. Unlike with active income, our job income, it goes up. The more you make, the more your tax rate goes up. Not the case in apartment buildings. It's fixed at a low rate. So you want more and more passive income. The second tax benefit of owning apartment buildings is it will reduce the taxes on your active income. Now, in the previous benefit, I was talking about passive income. Well, if you're making active income, for example, through your job right now, you're paying the highest tax rate on active income. And the more you make, the more you pay. Well, the IRS allows us to, through depreciation, to use that depreciation to offset how much tax we pay on our active income. Which means if you buy enough income producing real estate, you won't have to pay any income tax on your active income. That's right. You buy enough apartment buildings and it can actually make your tax bill on your job income be zero by the benefit of depreciation. In a moment, I'll talk more about that. All right, so we've already said you get the lowest tax rate on the highest income, that passive income of your apartment buildings. You're paying the highest tax rate right now on your active income, your job. That means you need to buy more apartment buildings so you have more passive income coming so you can pay less taxes on your active income. Isn't this a beautiful thing? The third tax benefit that you're going to have is with regards to your equity is short-term versus long-term capital gain on apartments. And for example, you own an apartment building. If you own it less than 12 months and you sell it for a profit, you're going to have to pay long-term capital gains. If you own it more than 12 months, you're going to pay short-term capital gains, which also is the lowest tax rate there is. So you want to be owning your buildings generally for more than 12 months. But let's talk about how you pay zero capital gains tax with apartments. So there's nothing lower than zero. So how are you going to do that? Well, a couple of ways. Tax-free sales of your apartments. This is known as a 1031 exchange. There's a provision in the IRS code. It's section 1031. You can look it up. Section 1031 of the IRS code says that if we sell an apartment building and make a profit, if we use those profits to buy another piece of real estate within a 6-month period, we pay zero capital gains tax. Zero. And you can do it over and over as many times as you want. There's no limitation to it. In fact, when you die and you pass that property on to your heirs, it resets with them. They don't pay your tax either. You can take that tax burden to your grave. Let them come collect it there. You pass it on tax-free to your heirs. It's called a 1031 exchange. And the ability to remove Uncle Sam taking a bite out of your profits every time you flip a building and use it to buy another building means you can boost your net worth that much faster because you're doing it without the participation of your partner, Uncle Sam. They're letting you take these profits 100% tax-free and using it to buy yet another apartment building so you can do it again and again and again. This is how you achieve $1 million net worth in 3 to 4 moves, by trading up, and doing a 1031 exchange. Now, another way, this is the 5th tax benefit, another way that you can extract your equity without paying taxes is to refinance the property and cash out. So let's say you've bought a building, you've raised the rents, you've raised the occupancy, you've created forced appreciation, you've driven the value of the building up. So now you can get the property reappraised at the higher value, put a new loan in place to refinance the building, pay off your old mortgage, and you can put a higher mortgage in place and extract part of the equity as cash. It's called a refi cash out. You're putting a new loan in place to harvest the equity that you've created through forced appreciation. That cash that you take out is tax-free because you're not selling the building. You're not triggering any kind of capital gains because you didn't sell the building. You're simply harvesting your equity. So that money you pull out, you take out tax-free. It is simply a loan. Now, you can choose to go spend that money on whatever you're going to do, or you could take that cash that you just harvested from equity and use that in down payment on yet another building and do it again. And really, that's what I want to see you doing, is getting a bunch of these oil wells running in parallel. You keep raising the rents, raising the occupancy, you raise the value, harvest the equity, and go buy more apartment buildings, aka oil wells, and do it all tax-free. Uncle Sam is your partner, and with his blessings, you get to do this. So again, like I said, you do this over and over, you hit $1 million equity in just a few steps. All right, so let's summarize the tax benefits. You got the lowest tax rate on that passive income, that apartment income. You're going to reduce your taxes on your active income, which is taxed at the highest tax rate. You got short-term versus long-term capital gains on apartments, and long-term capital gains are also amongst the lowest tax rates when you own a building for at least 12 months and sell it. But also, I showed you, number 4, how you can sell your buildings tax-free and never pay taxes through 1031 exchanges. And number 5, you can also, without having to sell the building, you can harvest your equity by refinancing it, pulling the money out tax-free, and take that as a cash out to use to buy more apartment buildings or use it for whatever purposes you want to use. All right, again, in the special report, How to Profit with Small Apartments, I go into this in detail as well. Now, again, in the show notes, I explain how you get your hands on that report. At the end of today's session, I'll also give you that phone number again. All right, the final topic for today's session is, all right, Lance, what are my exit strategy options? What are all the ways I exit from these buildings when I buy them? Well, just like there are multiple tax benefits, there are multiple exit strategy options when it comes to these apartment buildings. The first one I'm going to talk about is forced appreciation for a stable property. And then in a moment I'll talk about it on turnaround situations. So let's say you buy a stable property. It's got a good occupancy, it's in good shape, it's stable. Well, remember, I showed a moment ago, when we determine market value, the formula is the market value equals the NOI divided by the market cap rate, which says anything that we do to raise the NOI automatically forces the value of my building to go up. That is really what forced appreciation is. It's forcing the value to go up by raising the rent and raising the occupancies. Well, in the special report, There's examples laid out there, but I show you this math. I show that there's compound effects of raising the occupancy. And in the example I show there, I show that if you raise the occupancy on average just 5%, let's say you take the average occupancy of this building from 85% to 90%, that 5% increase in occupancy yields a 32% increase in your cash flow and a 64% increase in your equity. And this is all because you're buying through leverage. Remember that fifth attribute of the ideal formula. So again, let me say this. 5% improvement in occupancy yields a 32% increase in your cash flow and a 64% increase in your equity. Now, to see that math, I want to invite you to go to the special report, and it lays it all out for you. Okay, so that's raising occupancy. That's one way we force the appreciation. But, of course, the other way we raise the value is by raising the rents. And there's a same compound effect by raising rents on an apartment building. The example I show in the special report is I raised rent 4%. Let's say we took the average rent from $500 a month to $520 per month. 4%. Nobody's going to move out over that. What that shows is that a 4% increase in the rent yields a 16% increase in the cash flow and another 25% increase in equity. Let me repeat that. A 4% increase in the rent yields a 16% increase in the cash flow and a 25% increase in the equity. That's in addition to the benefits of raising the occupancy I just went over. And again, all that math in the example is spelled out in the special report. All right, so that was forced appreciation on a stable property. Let's say you want to get into a rehab, a turnaround situation, a not so pretty property. Well, this just puts everything on steroids. Because when you do forced appreciation on rehabs and turnarounds, it becomes big math on small properties. Because now you're not raising the occupancy from 85 to 90%. Maybe you're raising it from 65 to 90%. You're not raising the rent from 500 to 520. Maybe you're raising it from 500 to 600. And you start running that math, that's when you see not only six-figure increases in your equity, but seven-figure increases in your equity, all through the power of forced appreciation. Now, in the special report, I show an example there for the significant returns you get from forced appreciation on a turnaround type property. All right, the third exit strategy with these buildings is it's just buy them and hold them long term. And really, your prominent strategy with apartments is to buy and hold them. You do this for both the passive income, that's your mailbox money, and your wealth creation. Because with every door which you add to your portfolio, you are essentially creating more financial options for you and your family. Your initial objective is to accumulate enough doors until you have all of your bills paid by passive income. And that's when you have true financial independence, when you have options. Because at that point, you can choose to continue at your job, or you can choose to fire your boss, or you can choose to retire your spouse from his or her job. You can choose to stop your real estate acquisitions or accumulate even more doors to further enhance your lifestyle. Those are all good choices to have once you get this machine in place that you're accumulating doors, adding doors, and adding doors. Because I just want you to imagine this. Imagine knowing each month that you have your bills paid, even if you don't do anything. That's when you have choices. And that's where I want to see you, and that's where I want to help you get, is where you have financial choices, where you're not under the gun every single day to have to figure out how you're going to get the bills paid by the end of the month. And that's what apartments and passive income are going to afford you, is giving you that cash flow. That's why I want you buying and holding these properties, getting your hands on as many as you can, as fast as you can, while these interest rates are at lifetime lows and we have record cash flows. Because remember, You can be financially independent in just a few moves. It's not a lot of doors that you need to accumulate. I give an example in the special report, which shows in as few as 50 doors, you can be financially free. 50 doors. That doesn't mean you need to go out and buy one 50-unit apartment building. You just need to accumulate 50 doors. Start small. Start with 5, and then add on 10, and then add on 20. Now you're at 35, 15 more, you're done. Now you have total financial choices. But as you buy these buildings to own for yourself, don't forget the extra buy and hold tax benefit of depreciation that I talked about earlier. So let me give you an example of the depreciation tax benefits. Let's put a pencil to it. It's this. Let's say you're buying a $450,000 apartment building. And the value of the land is $50,000, so the value of the building is $400,000. Now this is important because you can only depreciate the building. You cannot depreciate the land. Well, the way it works with the IRS on commercial properties, the IRS says that we can schedule that building's value to be depleted over the next 40 years. Which means you take the $400,000 asset divided by 40 years. That means in the eyes of the IRS, that building is losing its value $10,000 per year. Now, in actuality, that is not happening. This is a paper loss. It's not a real loss. In actuality, the value of your building is going up, as I just showed you through forced depreciation. But on paper, specifically on your tax return, the IRS considers that you're having $10,000 loss per year. That means you can deduct that $10,000 per year against your job income and pay no tax on $10,000 of your job income. And if you're in a 30% tax bracket, you just saved yourself $3,000 on your tax bill for your job income. Which again, you buy enough income producing real estate and you could never pay taxes on your job income because the depreciation benefits will totally wipe out the tax burden on your job income. If you make $60,000 a year job income, then you need $60,000 per year of paper loss from the buildings you own. Pay no tax. Now, there's a caveat here. I'll make you aware of this. It's not a big deal, but I want you to be aware of it. The IRS will limit the amount of loss that you can declare. I believe it's limited, last time I checked, $3,500 per year. So that $10,000 example I gave you might be limited to $3,500, but it won't be if you declare yourself a real estate professional. And this is where you want to see your CPA, but declaring yourself a real estate professional is quite simple. As a matter of fact, it has nothing to do whether you have a license or not. That is not a qualification. In the IRS eyes, you are a real estate professional if you spend at least 750 hours per year in real estate. And not whether you make a profit or not, do you spend 750 hours per year in real estate? That's 15 hours per week. Well, if you're following me and you're doing this on a part-time basis, I'm quite confident you're spending at least 15 hours per week in your real estate business. And if that's the case, you simply need to have your CPA check the box on your tax return that says, yes, I am a real estate professional, and that will remove the $3,500 per year cap that exists on paper losses from depreciation, which is clearly a box you want to get checked. If you're not working 750 hours per year, then change that. Increase it and start buying buildings so you can get the full benefit of tax depreciation and decrease the taxes you're paying on your active income. All right, the fourth buy and hold strategy, and the final one we're talking about here is fixing and flipping. And this is the process, we talked about above, when you buy turnaround and rehab type properties, you're going to have the opportunity to really enhance the value. Again, imagine taking the occupancy from 65% to 90% and the effect that would have on the value of the building. You could have 6-figure and 7-figure improvements. And this is the fix and flip world where you buy them cheap, distressed, put some improvement into it, put some rehab, and significantly raise the value so you can then sell the building and do a 1031 exchange and take that windfall profit you just made, use the down payment on the next deal. This is called How to Cap Out a Property, and it simply means anything we do to raise the NOI boosts the value of the properties. And if you are a rehabber now, for example, on single family houses or small properties, I want to encourage you to start doing it in apartment buildings, because it's the same thing you're doing right now, but on steroids, and you're going to get a much greater return on your effort when you start improving and doing forced appreciation on these commercial buildings. So let's summarize those exit strategies. Number one, you got forced appreciation for both the stable property situation, raising the rents, raising the occupancy. You got the same opportunity on turnaround properties. You're just going to multiply your returns. You got your long-term buy and holds, which you want to be doing for cash flow to generate passive income, to give you financial choices. And you got the fix and flips, where you go in, buy them distressed, fix them up, sell them for 6 and 7 figures. And if you do it on 1031 exchange, you pay 0 taxes. Is this not a beautiful thing? I mean, it's everything here. That's why it comes back to this is the ideal investment. It has all 5 attributes in apartments for your ideal investment. And this is one of the many reasons that I chose to get started in small apartments. All right, that's our session today. Remember, I want you to get my special report, How to Profit with Small Apartments. It covers everything I just talked about today, gives all the math examples in detail. I want you to study that. You're going to be amazed at this math, because a lot of times people don't even believe it until I show it to them. Again, text your name and email to 832-446-1772, 832-446-1772, and within 10 minutes, we'll email you this special report that will go through everything that we talked about in today's session. Listen, I want to congratulate you for showing up today. I want to thank you for joining this session of Greenlight REI. I want you to go to the show notes. We'll have a lot of free stuff there for you. We'll certainly have the links to get the special report as well. If for some reason you missed, well, we got here something pop up here. In any case, reason you missed the, for any reason you missed the phone number, we'll put it up on the show note, that phone number, so you can get your special report. To listen to the archives, I want you to go to greenlightreinvesting.com. Greenlightreinvesting.com. We got a lot of free stuff there for you, even more information about apartments. Greenlightreinvesting.com. Until our next session, go out, work the math. Make apartments give you choices in your life. Take care, everyone. Goodbye.